So we're starting our global range this morning with the Nedgroup Investments Global Property Fund. It's a strategy that plays a very specific and increasingly important role in diversified portfolios. I'm joined by Marco Colantonio from Resolution Capital. Marco, thanks so much for joining us.
It's a pleasure. Thanks for having us.
Marco is a co-portfolio manager of the Global Property Fund at Resolution. So Marco, I guess turning to the portfolio's performance then, obviously it's been a very tumultuous quarter with the war in Iran, for example, amongst many things. And the fund is actually up as well, quite interestingly. Do you want to talk us through it, please? How do you deliver returns in this kind of environment?
Yeah, sure. So it was a good period for real estate over the quarter. Real estate, in fact, outperformed global equities, which were down about mid 3% range. And global bonds were just slightly negative. And so real estate or the fund at 1.6% was a good, solid performance. And really, it's been a good year for real estate more generally, compared to several years where real estate has had some challenging returns. And look, I think part of that is investors had, earlier in this calendar year and during the second half of last year, had begun to recognize the relative value of real estate. And, obviously, for a long period of time now, capital has been flowing to other asset classes, obviously Mag 7, real estate private credit, gold, and a whole range of other factors that, valuations got quite frothy in other segments of the asset universe. And real estate, when, hopefully we'll talk a bit more about the fundamentals in a moment, but real estate fundamentals have actually been quite good for some time. So I think to some extent recognition that real estate represents good relative value and backed by tangible assets and contractual income has led to relatively good returns over the last 12 months and over the last quarter.
Thanks, Marco. I definitely want to zoom in on the past quarter specifically now. And if we can talk through some of the attribution analysis, what would you say were some of the big influences on performance over the quarter?
Yeah, so look, over the quarter, we had strong positive contribution from diversified REITs, and in particular from Hong Kong, where the Hong Kong real estate market has really been struggling for the best part of 7 years. But in the last 12 months, it's seen a bit of a positive inflection, particularly on the back of improving house prices, which troughed about 12 months ago. And that's a combination of some mainland Chinese buyers, lower interest rates, and a pretty buoyant Hang Seng stock market index contributing to better confidence in the Hong Kong property markets. We also saw strong positive contribution from diversified holdings within Japan. And I think it's an interesting case study in Japan because Japan's one of the markets where we have had increases in interest rates over the recent quarters, and yet Japanese real estate has been amongst the strongest performing markets. And so proof that supply and demand fundamentals often outweigh short-term interest rate concerns that the market often focuses on. And in Japan, we've had very strong supply and demand fundamentals. The vacancy rate in the Tokyo office market is approaching 1%. That compares to close to 20+% for many office markets in the US. And they're seeing strong rent growth for the first time in many years, buoyed by clearly a resurgent economy, local economy, and also a return of inflation after nearly 40 years of deflation. So important that operating fundamentals are strong there. And then also we've had strong contribution from our exposure to data centers. And we're particularly pleased with the performance of Equinix, which has had a strong period after a bit of a wobble mid last year during their Investor Day. And our underweight exposure to residential also contributed positively. Residential rents have clearly slowed from the very strong rent growth that they were experiencing during the pandemic. And so they were all positive contributors. On the negative side, there were some detractors from the self-storage sector, and that was really a reversal of a very strong contribution from the prior quarter. But also some exposure to the UK, and the UK more broadly was pretty hard hit by the rise in interest rates on top of an already stalling economy, and particularly concerns since the Middle East conflict broke out around the reliance on energy imports. So the UK and the self-storage names in the UK were detractors over the quarter.
Thanks, Marco. I guess it's when dispersion happens is exactly when active management adds value. You brought up the point about supply-demand dynamics. Definitely want to chat about that. And you also mentioned about Equinix. I think definitely worth talking about that in a bit more detail as well later on. So, just back to supply-demand dynamics. I mean, how's global supply looking, and what does it mean for kind of generating future real returns from the asset class, please?
Yeah, so look, from a supply perspective, global listed real estate is in fantastic shape. Supply levels are below the long-term average, and that's really a consequence of construction activity having been depressed and developers being less incentivized to begin new development projects over the past really sort of 3 odd years, because over that period we've had a significant increase in construction costs. We've had increases in interest rates from their 2022 lows, and we've also had property values coming under a bit of pressure because of those higher interest rates. And so as a result of that, development is not economic, and we're seeing less and less new construction activity. The only area where we are seeing some construction activity is in data centers. Clearly, a lot of headlines about a construction boom in data centers, and in fact, that is in fact detracting or attracting capital away from some of the more traditional property asset classes. And as a result of that, we're seeing a significant reduction in supply. And if we think for a moment about the outlook for supply, particularly in the context of the conflict in the Middle East, with fears over higher energy prices, higher inflation potentially, higher interest rates, and perhaps disruption to economic growth. Well, those factors all contribute to probably even less confidence from developers to begin new projects. So we expect that you're going to see even further declines in supply in most of the traditional real estate asset classes. And that's a very good setup for existing landlords as we enter into a period of potentially more macroeconomic uncertainty, because you do not want to have that macroeconomic uncertainty as we have too much supply. So in fact, we've got really positive supply dynamics going into whatever macro volatility that we now face.
Marco, that is quite interesting. I guess if we turn to the demand side of the equation now, you mentioned about Japanese vacancies being very low at around 1%. I mean, what would you say more broadly if you look at, let's call it different sectors of the market?
Yeah, so it's really interesting that demand, and as we look at occupancy as a proxy for demand, total occupancy levels for REITs is actually above the long-term average. And when you pair that with our earlier point about supply being below the long-term average, we think it's actually a very positive backdrop. And the specific segments that when we look at occupancy levels, clearly the outlier on the negative side is office. Office is still feeling the effects of the disruption from the pandemic when a lot of people were working from home. And now clearly there's a lot of concern going forward about the potential impacts of AI and the possible job displacement, particularly white-collar job displacement that may occur in the office markets. And so office occupancy levels are still very depressed, and that's why office is the largest underweight in our portfolio. But if we look at most other sectors, and I'll start with retail, retail occupancy levels are at 20-year highs. And despite all the concerns about what may lay ahead in terms of affordability for consumers with rising fuel prices and rising interest rates and inflation, retail sales have actually held up pretty well. Admittedly, we don't know the direction going forward and the duration of the conflict in the Middle East, but at least retail is going in with very high occupancy and record low levels of supply for really nearly 17 years of continuous levels of no supply in retail. And then when we look at apartments, they've been resilient and continue to be above the long-term average. Industrial has come down a little bit from the peaks of the pandemic when there was a supercharge of demand from home delivery and supply chain resilience. But industrial has now bottomed and beginning to inflect positively. And one of the other outliers during the pandemic was seniors housing. And seniors housing, clearly they dropped occupancy and demand because they weren't able to accept new residents during the lockdowns. But post-pandemic, we've seen a strong rebound back to pre-pandemic levels of occupancy. And our expectation going forward from here is that we're going to see seniors housing occupancy reach new record highs over the coming years because you have that aging population tailwind, and matching that with continued constrained supply, we expect to see strong new records being set for seniors housing demand and therefore occupancy.
Thanks, Marco. And I guess just in terms of the property cycle more broadly, what clues do we have to support valuations at this point?
This is another very interesting point, is that real estate, as I mentioned earlier, has sort of been overlooked for a number of years as people got more excited about other asset classes. And as a result of that, real estate values have corrected by circa 20% from their peaks in late 2021. And at the same time, we've had rising construction costs. Since 2019, cumulative increases in construction costs are running at around about 40%. And so we've seen a decline in real estate values, but an increase in construction costs. And as a result of that, real estate is now trading at a discount to replacement cost. Now, that's an important metric that we look at because it is an indicator of a floor to some extent in terms of how low real estate values might go. And in fact, we're seeing real estate values bottoming and beginning to inflect positively. But it's also a strong driver of why we have low supply, because it just does not make economic sense for developers to start a whole lot of new supply. And so if we match markets where there's low supply, where there is some level of tenant demand, and where real estate is trading below replacement cost, then the only way that developers are going to get incentivized to begin new construction to meet that demand is if they see significant increases in value or increases in rents. So we think that there's potentially a significant spike in rents or values based on the fact that real estate trades at discounts to replacement cost as an important value metric, which gives us confidence about the downside protection that real estate values provide right now. But real estate also trades at discounts to private market real estate transactions. Listed real estate trades at discounts to private market values, and multiples versus equities are at a discount as well. Obviously, the last few years, the S&P 500 and broader equities markets have been very strong performers. Real estate's been somewhat overlooked, and so we're seeing a wide gap in real estate earnings multiples So on a number of different metrics, we see real estate as trading at attractive valuation.
That's interesting. I mean, you've shared quite a lot of insights with us now over the past few minutes. I mean, Marco, how is that reflected in the way you've positioned the portfolio, please?
Yeah, so the portfolio is positioned towards segments of the market that we think are exposed to secular demand trends. So particularly with overweight exposures to seniors housing, which is categorized as healthcare, where that aging demographic is continuing to drive demand. The population growth rate for over 80s in the US is projected to grow at about 4% per annum compound over the next 15 years, and yet supply is at a cyclical low. So that's a really important overweight exposure for the portfolio. We're also overweight to data centers, where again we see strong secular demand. And we're exposed to retail, where we see exposure to higher income demographics in inner urban locations where there is limited supply. Our underweight exposures, as I mentioned earlier, office is our largest single underweight exposure, given those concerns about AI going forward, but also the lingering effects of the work from home and low occupancy. And we also have an underweight exposure to industrial after we think that the e-commerce boom, while still growing positively, is not quite as strong as it was historically. And yet valuations are still, we think, in industrial somewhat elevated. So we do have an underweight, and industrial is somewhat economically sensitive, and with fuel prices, etc., we may well see some efficiency gains being directed towards warehouse use and warehouse space, both from third-party logistics companies, but also through some AI adoption in that industry as well.
Marco, you've mentioned about your overweight to data centers, and earlier on as well, you've mentioned about Equinix, which, given the theme around hyperscalers and AI globally, it does seem like quite an interesting holding that you have within the portfolio there. Do you mind just touching on that, please, for a moment?
Yeah, sure. So Equinix is quite unique in the global data center space because they are focused on what's called retail co-location data centers. And we believe that this is the area of data center where the market is going towards, particularly as more and more people utilize AI. So that's the phase called inference, AI inferencing, as opposed to AI training, when all the models are doing their learning from the large data sets. The training is happening in very large data centers. Very often they can be located in peripheral locations where there's cheap land and power. But ultimately, when we use AI, we need to be in data centers that are close to the end user with low latency. And so Equinix does exactly that. It's located in key major metros, close to the cloud on-ramps, and are providing that low latency AI inference that we'll all be using more and more as we go forward. And so while a lot of that supply, a lot of that development is being focused on AI training facilities, Equinix is more focused on that usage and that inference phase. And we think the runway for demand there is very, very solid. It's a global portfolio. It's been established for over 30 years, has a long track record, established track record, and established customer relationships, and is projected to grow earnings at over 9% per annum compound in the next couple of years.
Great. And then, Marco, I guess just finally to wrap up everything, given all the views you've shared with us, how are you thinking about the opportunity set for listed property at the moment?
Yeah, so we're very constructive about the outlook for global listed real estate. As we touched on earlier, we're seeing below average levels of supply being matched with above average levels of demand. And we've positioned the portfolio to areas of the economy where we see secular growth, particularly in terms of the aging population through seniors housing and through the digital economy through data centers. The REITs have strong balance sheets. They're backed by contractual income, which is higher than the dividend yield that you get through other areas of the investment markets. And valuations are attractive. After several years of being overlooked, real estate values are trading at a discount to replacement cost. They're trading at discounted multiples versus equities, and they are trading at discounts to private market real estate values. So all in all, we feel very constructive about the outlook, and we are very pleased with the positioning of our portfolio as it stands today.
Marco, that's brilliant. Thank you so much for your time this morning.
A pleasure. Thank you very much.